Okay, so we are here. Let me know if the sound is good. I could always turn the gain up. I have Carol with me today. Carol wants to learn about economics and like Fed meetings and decisions. And so I figured I could bring her on, and it also might be kind of educational for other people. So like I can explain stuff to her, and then people at home can kind of find this useful. Yeah, I don't think we're going to get the Bitcoin news today, Sam. But yeah, let me know how the sound is. I can always turn the gain up more. So far, here is the SPY itself. SPY is pumping up to 595s today. It's been a very strong market. If we look at it, a very strong market. And everything is up a lot. Today, the Federal Reserve is almost certainly cutting 25 basis points. We'll go over that in some detail later. And yeah, the FOMC is almost certain to cut rates 25 basis points today. More importantly, Jerome Powell will speak on future economic outlook. That's the big thing. So like we know Jerome Powell is going to cut rates 25 basis points. All right, so we got this up. Let's check the chat. Yeah, we're gonna have to fix the camera here. Let me see. Wait, you want to put it over here? Mm-hmm. Yeah, that's probably better, right? Yeah, like that. All right. And again, I'm gonna put a timer up. The FOMC decision being one of our largest streams. So every time the Fed speaks and does this decision every 6 weeks. So the decision will be right when this time runs out. And the decision is regarding interest rates throughout the country, you know. So really what they're affecting is short-term rates. Like the federal funds rate is short-term. So when the Federal Reserve influences and moves this up, and today they're going to be moving it down 0.25%, so 25 basis points. When they do this to stimulate the economy. You know, they bring interest rates down when rates are lower and people are spending less money on lending. Then they have more money to spend. You know, they also have cheaper access to lending, and so they end up spending more, buying more stuff, buying more investments, rental properties, you know, all that good stuff. But what these rates are directly influencing are short-term lending. Like really it's like adjustable rates. So adjustable rate mortgages are directly influenced by this, because a lot of the adjustable rate, not adjustable rate mortgages, these are influenced by it, but adjustable rate loans in general are influenced by the federal funds rate directly, because a lot of them are based purely around what the federal funds rate is, and that's what influences directly the adjustable rate mortgages. You also have like home equity lines of credit that are directly influenced by these, and that will influence long-term rates as well. Again, it'll kind of trickle into long-term rates like mortgages and auto loans and stuff like that, specifically because it just takes time and it adjusts a lot of different things like bond prices. Waking up drinking my tea. Is this yours?
Yeah.
Okay, here, I'm gonna drink that. And you could just look at the chat, Carol, and answer questions too. We're almost certain to do 25, right? We're almost certain to do 25. The likelihood that we're not going to do 25 is super, super, super low. Like the likelihood that we're going to go outside of this expectation here is super, super, super low, right? And you can kind of see currently we're at 475 to 5. This is 4.75% to 5%, right? So currently this is where we are now. Again, I can zoom in here. Oh, no, I heard it. Okay. Yeah. So currently we're at this number, 4.75 to 5%. Today, it is 99% likelihood that we're going to cut it down to 4.5 to 4.75%. And again, these are short-term rates. And so an example of this is like an adjustable rate loan after today, instead of an adjustable rate loan paying anywhere between 4.75 and 5%, they're going to pay anywhere between 4.5 to 4.75% after today when they cut rates 25 basis points. And like that's how you have to understand it. It will trickle into everything else, but yeah, that's basically what it means. It stimulates the economy in a more significant way, you know.
Okay.
What's John expecting? What's up, Frost? Yeah, that's my wife, Carol.
Hello.
She doesn't know how to act on stream, and that's okay. She's just not used to it. She's not used to it. I'm sure she's a little nervous, and so everybody just kind of, you know, everybody just kind of, you know, be nice.
Be nice to me.
Yeah.
I'm here to learn. I don't really know, like how John does this every day, and he kind of understands all this stuff. I'm trying to understand more. So.
Well, like this is like the Super Bowl of the stock market every 6 weeks. Not the stock market. This is like the Super Bowl of economics every 6 weeks. Every 6 weeks, the Fed does this. Influences rates. Like an example is if inflation is bad, they sometimes raise interest rates to combat inflation. You know, they want to discourage the economy and the only
from spending.
Right, they want to stop people from spending as much, push inflation down, because when people spend more, inflation goes up, businesses raise prices. And so what they try to do is they try to discourage that spending by raising interest rates. And this is what happened in like 2022. After the pandemic happened, we did a bunch of what's called quantitative easing, which means that like the Fed printed a bunch of money, used that money to buy up, like to inject liquidity into bonds and other financial assets. And it stimulates the economy. We also send out stimulus checks in 2020. We did all these things that made inflation worse, like money printing, stimulus checks, which is another form of money printing.
Yeah, I remember all that.
Yeah, and that's really why a lot of people are unhappy today, is because inflation spiked up so dramatically in that period of time. But inflation started to spike up after they did all those things in 2020, and you can't really knock them for it, because if they didn't do it, like if they don't do these stimulus measures, then we enter into like recessions and depressions, which people would be even more unhappy about. But after they did it, inflation spiked to like 10%. And so you can kind of see if we look at like CPI inflation. Let me get some music playing. I'm realizing music makes it less awkward for sure. You know, music definitely makes it less awkward. All right, let me see. What are you guys feeling like today? We could do some, man, there's a genre of music called grime. What does that sound like? I'm just genuinely curious here. So don't get mad at me if it's crazy. This is grime. You hear that? I don't know what that means, but you learn something new every day. And so yeah, guys. So basically, where was I? Okay, yeah. So after 2020, you know, the Fed brought interest rates down to almost zero. The consequence was this right here. You see this big increase in inflation. This is inflation. So inflation went from growing at 0.1% when the economy was super weak to growing to 5.5% by August of 2021. By June of 2022, it was up to almost 10% at 9 point something percent. And so prices of everything rose to almost 10%. When the Fed sees this, their response is to raise interest rates, right? So if you look at like the federal funds graph here, which we can put up, when the Fed sees that inflation spikes, their logic is to raise interest rates. And so look, you can kind of see around the same period of time, you know, here's April of 2022, the Federal Reserve starts to bump up interest rates, you know. So now we're at 5%. Prior to this, we're at almost 0% for short-term rates. So like adjustable rates in this period were loving life because they don't have to pay almost anything in interest. They bump rates up all the way leading into 2023, and then we paused rates for like a year straight. We only brought it out of this pause decision in September. So the month before last, we did our first rate cut of the year after raising rates aggressively and all this stuff. And really, it was the first rate cut that we've done since 2020, February of 2020, when we brought them down to begin with to try to save the economy from the disaster of 2020 and the accompanying years. And so, yeah, we finally started to drop rates here. You can see we brought rates down from 5.3. It's 5.5 to 5.25 is what this is. And then we brought it down. And we're expecting to bring them down again another 25 basis points. So the whole thing is just to stimulate the economy. It will affect long-term rates like mortgages and stuff, but it just takes longer periods of time.
All right. So overall gist is basically they're trying to discourage people from continuing to spend.
Not anymore. So now it's kind of the opposite. So now inflation has slowed down, right? So if we look at inflation now, and the Fed likes to use not CPI, but they like to use one called the personal consumption expenditure. I don't know what I've done with this, but yeah. So if you look at, we can look at CPI. CPI is like the most watched inflation metric. It's called the Consumer Price Index. We can look at that. Inflation has dropped enough. Right now, September is down to 2.4%, which average is like 2 to 3%, really, a year. If you look at like over a long run, let me get my little pin out here. Yeah, if we draw a line through this, it's going to be about 2.5%. And that's right around where we are now, about 2.5%. So we're right around average for inflation right now. And I know me saying this might be, some people are going to be like, nah, prices are still really, really high. And the reason they're still really, really high is because they don't go back down, right? This is the rate at which prices go up. And so prices aren't going back down. Once they go up, you're stuck with them. The best we could do is slow it down in the following years, if that makes sense.
Okay. Because, yeah, I know for me, like, I do like grocery shopping for a family, and there's a big difference between, buying food pre-pandemic. Yeah. And they haven't gone down. So I just hope that they don't continue to go up. So I guess that's good.
Well, so food is a little bit more volatile, right? So like food prices move up and down in greater percentages. So there's much more volatile. A lot of people look at what's called core CPI, which is core excludes food and energy, basically food and gas, because food and gas will go up big and down big and up big and down big. And so there's a bigger margin of,
and that affects everything.
And so to get rid of all that volatility, they just look at what's called core inflation. And so what we're going to listen to today is basically what, let me see if I can give you a little name place. Okay. John and Carol. There we go. If you look back 3 years, inflation is still up about 100% on basic essentials. Yeah, for sure. I mean, and listen, they're not going to go back down, right? So, okay. Progress to inflation would look like this instead. So if we get rid of this graph, right? So say this is inflation, right? If we have progress to it, instead of going like this, it'll go like this. So point is, it's not going like this. It's not going to go down. If you look at CPI inflation graphs, if you look at CPI inflation graphs, the only time inflation actually goes down, like literally goes down, is in like deep global recessions like we got in 2008. We might have gone down for a little bit here, not really, maybe for a little bit there, but in 20 years, the only time prices have actually dropped ever is in 2008 mortgage crisis. That's it. Okay. The grime was good for the first few songs. I think I'm just gonna
change it up.
Yeah, I don't know if I'm feeling the grime today.
What do you usually do?
I usually do like lo-fi, laid back. Let me see. So I usually do like hip hop instrumentals, and then do a mix of like this. Oh, y'all can't hear the music, man. I've been sitting here talking for this whole time. Y'all don't hear the grime. Okay. There you go. Now you can hear it. Bring that trap beat back. How many minutes left? Yeah, so we got 42 minutes left. Yeah, that's my wife, Carol. Play the Pokemon theme song. I'd get copyright striked real quick. Pokemon would say, "Where's my money?" Yeah, You buying at 2 p.m.? I'm not buying anything right now. It's just too risky to buy. We don't know how. Again, it's overwhelmingly probable we're going to cut rates 25 basis points. So, like, we're probably going to cut 25 basis points. You can always look. Again, every time we have one of these meetings and one of these decisions, some people in chat are out here making these wild predictions. Like, we're going to do something shocking. Like, an example of that would be like, we're going to raise rates today. And it kind of just goes to show the full like range of predictions people have. But if you look at this 30, 40 minutes before the decision, you'll know what they're going to do for the most part. Like through this, we know they're going to do a 25 basis point cut. And there's a 1.1% chance of a pause in interest rates, which means that they just leave them alone. They don't touch them.
But didn't he say in the last meeting that they were going to kind of, from that point on, they were going to continuously cut rates, but that they were going to slowly kind of bump them down over time?
Yes. He didn't say, right? Jerome Powell
or hint
is intentionally vague when he speaks, right? Like every Q&A they get, they'll do a Q&A after the meeting or after the decision and during the actual press conference. They'll do a Q&A. Every time they basically ask Jerome Powell in one form or another, hey, what are we going to do the next meeting? And he will never be specific. He's never like, yo, we're going to raise 50 basis points next meeting, or hey, we're going to cut 50 basis points next meeting. He's never going to be super specific. He's going to intentionally be vague and leave it up in the air. A lot of the time he'll say like data dependent approach. Like, hey, we're going to take a data dependent approach. Like basically we're going to wait for the data to come in and then use that to influence our decision. So they don't know yet. But he'll sometimes also give a more specific answer, and like he'll say, hey, this is the base case, like it's probable right now that we're going to do this, but that is definitely subject to change.
Okay.
John is the most legitimate financial YouTube influencer in the game. Why?
Top 3.
Definitely top 3. Top 3 worst day trader ever too. Yeah. If the Fed cuts 50, the 10-year is going to go to 5%. Maybe. I don't know. Michael Jordan, why are your PSA 10 cards from the 90s so expensive? I'm going to tell you this, bro. In the 90s, in the early 2000s, nobody thought those cards were going to be worth anything, right? Like, y'all are seeing the big sports card boom now, but I was a sports card kid. Like, I had basketball and baseball cards, Pokemon cards. I was a collecting kid. You know, I used to trade them at bus stops.
Yeah, I had Pokemon and Beanie Babies.
The problem I have with them now, Beanie Babies, man, those freaking things, bro.
Man.
Everybody thought, you know,
they had like full-on conventions where you could buy the rare ones or whatever, the Diana.
Yeah, that's like the big one, the Diana one, you know. But again, the problem with it is they got saturated.
Yeah.
One of the things that you saw, like when I was young, and we had Pokemon cards, 1 out of like 3 packs, you're getting something expensive, right? So like, you know, maybe 1 out of 10 packs, you're getting something big, right? That you could probably sell for like $100+ or more. If you buy packs today, my son's still into Pokemon cards. If you buy packs today, they have diluted that amount down, where I have probably bought my son, like 50 Pokemon packs in the last year or two, like literally like 50 packs of Pokemon cards. I don't think I've gotten one card ever worth over $50 in 50 packs of Pokemon cards. And so the amount of valuable cards in them now are so diluted.
Yeah,
so
but
like,
if they kept putting valuable ones in every pack, how would they be valuable?
They don't need to put
so
them.
Many of them.
They don't need to put them in every pack. They need to put like 1 out of 10, 1 out of 15 at least. Like in 50 packs, I should have gotten at least like 2 or 3 cards that are worth $50 or more. Right, 50 packs, that's freaking hundreds and hundreds of dollars. Like they
you buy way more Pokemon packs than I would buy them.
Right, for sure. And I just do it for nostalgia because that's what I did growing up. But like they've diluted them so much, unfortunately. Garbage Pail Kids. What's up, relaxation?
Bazooka wrappers.
Yeah, man, I remember those.
Yeah.
Do you believe in the daily 1% gain rule? What a ridiculous rule. So you're telling me you should shoot for 1% gains a day, right? Like, bro, listen, you make 40% a year. You're in like the top 1% of traders in the world. 40% a year, right? So you're telling me you need to make 1% a day. How many trading days are there in a year? Like hundreds. So you're telling me you got to make hundreds of percent a year. If you can do that regularly, Goldman Sachs will hire you, you know? And so ask Carol why she calls you every day at 9:28.
Sorry, it's not intentional, I promise.
I know why she calls me every day. She's just being considerate. She's telling me, you know, but don't tell them, because then you'll get stalkers or something weird.
There's a reason. I promise it's not intentional.
Yeah.
I'll be more mindful in the future.
You can pull 40% of trade. Sure, you can. Gambling your whole account away, risking your whole account. You can make 40%. Sure. You can also lose 100%, which is why it's not really brain rot trader. That's a new name, honestly. My daughter makes fun of like brain rot. My daughter's in high school, and brain rot is the word for like the crazy slang, like skibbity and you know, like no cap, like all the slang they use nowadays.
That and fever dream has been a new one that she's
fever
been,
dream, man. Yeah, she's been using that one for like a year and a half now. Yeah. We learn all the cool words because, you know. Yeah. Well, NASDAQ, Dow go up if there's a rate cut. Rate cut's pretty expected right now, Mo. And so a rate cut's pretty probable. Like it's gonna happen. If it doesn't happen, you can call me dummy for the rest of the day. But like it's gonna happen. Carol has nothing to apologize for. Yeah, no, I don't, you know.
Oh, thank you.
I joke because she's the worst timing ever. Like she has the worst timing of all time. Like no matter what big economic event I got going on, she's showing up 2 minutes before it happens, wanting me to mute the stream for 5 minutes. Worst timing of all time. You know?
Yeah, no, I promise. It's really not intentional.
Worst timing. We recently changed it, and she's gotten a lot better because I had to talk with her and I had to be like, yo, you're coming in here a minute before like the whole stream's dedicated to an economic report that drops at 8:30. You're coming in the stream at 8:29 wanting to talk. And like that's not usually, we can't do it.
Yeah.
Kids are about to go to school. That's why they're trying to bring them in here. I can give them hugs and stuff. Like that's what they're trying to say
bye for the day. Yeah. Sorry.
Yeah, definitely top 3 worst timing ever. But 99% chance that we're gonna cut rates 25 today. We got a 1% chance that we're gonna pause. So pretty probable. Markets since the election, and I'm not saying I agree or disagree with anybody or any politician. I'm pretty neutral, but markets are running ahead of this. S&P right here. Here's basically the night of the election. Gapped up a huge amount. Yeah, it's up big. If you look at like the Q, the NASDAQ here.
Yeah, I saw the NASDAQ.
It's up a big amount too. Today it's up even more. What's driving these stocks up? I know like Tesla is up big today. Nvidia kind of leads the whole market. Microchips and AI. It's up a little bit. Apple's up big too. Where's lifetime highs on Apple? Okay, so Apple still got a ways to go. All-time highs for Apple are at like 240. All right, so yeah, where's the Dow at? I haven't even looked at the Dow. Dow's up big too today, man. Last few days, not as much as the other one. The Dow's less diversified. It's only 30 stocks. Gold. Yeah, because Carol's always telling me to buy gold, but the problem with gold is like it'll downtrend for 5+ years.
Well, it's gold and silver. I feel like, especially with silver is needed for all of the tech that is being pushed out into the world, and so it's a finite resource, and so
sure, but
they're always going to need it, you know, that and rare earth minerals,
right? But don't you think that might actually make them keep the price lower because they need it for technology, and so they have an incentive to keep the price low versus allowing it to go super high? And big money controls these things for sure,
and that might be the case, but there's only so much of it. So I mean,
true, right? True. Gold is different though. Like here's gold long term, and again, gold is a great chart. You know, gold back in 1975 was $200 an ounce. Today it is almost $3,000 an ounce. So gold's a very strong long-term chart. The problem though is that when it starts to downtrend, like here's an 8-year downtrend. You know, here is really this downtrend was for like 25 years. So gold can downtrend a long time, and it's been pumping up big too.
Yeah.
And so that's the only risk. The other thing is, like, I was having this conversation. I'm curious, Carol, to get your perspective on it. I was having this conversation before. If stuff ever hits the fan and we have like a ish hits the fan scenario, do you think gold will really be valuable? It's a shiny rock. It has no utility. It serves no purpose.
It might have some, but I think it's going to be more into like resources
Food,
that are usable
tools.
for the people. Because if there's no financial system, like if there's no like system for the currency, people are going to resort to other things that they actually need, resources that they actually need.
Medicine,
food,
tools,
energy, like gasoline, gas, stuff like that.
100%. I get people on here that invest in gold in case stuff ever goes crazy, and I always tell them, like, it's a shiny rock. It serves no utility. Like,
but
it has no purpose.
Historically,
it's good.
It's always been the kind of cornerstone of
It's a great inflation hedge. It really is, right? Like just in terms of general investing, it's great. But
and it's a semiconductor. That's true.
So we'll see.
If you're talking about like a
crazy
STF situation and the grid's down, I mean,
it's not going to be worth anything.
You're not going to need semiconductors unless you're rebuilding.
Right. Yeah, I agree. All right. So there's the SPY. There's the Q. Here's a daily chart. They're going to queue up to 512s. Still got 30 minutes left until the Fed decision, and then the actual press conference is going to be at 2:30. Yeah, for sure. Lolo says, yes, gold is instant liquidity. I can walk down the street to my local dealer and sell for quick cash. 100%. Yeah. Gold's super liquid. 1 to 2% allocation of gold's fine. Yeah. Diversify.
But at the same time, the scenario you're talking about is like just a one in a million type of thing where you're talking about a STF situation. That's different than, if the world is still going round, you can still do that. You'd still be able to go and, get cash for gold or whatever. But
no, I agree.
Very different.
Scenario. I 100% agree. And as long as things continue to go as like they normally do, gold's going to be fine. And so I always tell people gold's great long term, right? Yeah, gold's great long term. Short term is risky. It always is. Holding a lot of gold feels dangerous. Well, you got to diversify, right? Diversification is the key to investing in anything. You got to diversify. If you don't want to diversify, you're setting yourself up to fail. So you got to buy a bunch of different things. Somebody's bringing up, like even like Rolex prices, right? Like if you buy a Rolex, people make fun of people that buy Rolexes, but Rolexes generally appreciate in value. So like you could buy a Rolex, wear it for 10 years, and then sell it for 100% more than you paid for it, right? So tell me who loses in that situation. Tell me if that's financially irresponsible. I don't think it is. I think diversifying into all these different stores of value is smart, and I think you want to buy things that go up in price. Rolexes go up in price. Gold goes up in price. Real estate goes up in price. What do you not want to buy? You don't want to buy things that go down in price. Cars. New cars, down in price, almost certainly. Clothes never hold their value. Purses never go up in value, right?
Unless they're collectors and you never use them.
Yeah, but even still, I doubt they're going to go up. Pointless. They're still probably not going to go up in value. They might hold their value, but they're still not going to go up,
Well, actually, and maybe this is a rarity, but I know like Louis Vuitton, I had gotten a purse years ago, and when I went back in, I had to have it kind of fixed up a little bit. And because the purse was discontinued, and it's kind of more of a niche kind of thing where you can't, I don't know, but they said it was worth more than it was when I bought it.
It's possible.
Kind of all ragging and stuff, but I feel like that's kind of a rarity. That's not with all purses. Most purses, it's only like the high end, kind of the same thing with maybe Rolex,
right?
Where it's
well, like Rolex's ones with names are the ones that appreciate. Most of them are going to go up in value, but like this one, as an example, is a what's called the Batgirl Rolex. Ones, if you want to know if you want to buy a Rolex or not, ones with nicknames go up in value. So there's a bunch of them. There's like Starbucks, there's the Coca-Cola, there's the Batgirl, the Batman. There's a lot of different Rolexes that have nicknames. There's the Daytona. Like there's so many different ones. If it has a nickname, I'm not going to say it's a good investment because short term it's very volatile, and so prices can go up, down, or sideways. Generally, at the very least, over a long period of time, it's at least going to hold its value. Yeah, let me do a poll. But again, the key is you just want to buy stuff that goes up. And unfortunately, the things that don't go up in value are sometimes the things that make you look the coolest. Like a Lambo, I love Lamborghinis, right? If I could buy one and have any type of justification for it, like as a business vehicle or whatever, I'd probably buy one. The problem is that there really isn't any, and it's going to go down in value. So no matter what, it's just not, unfortunately.
Well, it depreciates as soon as you start using it.
It's a wildly depreciating asset.
So, yeah. I mean, that makes sense to me, though.
Yeah.
I mean,
well, the Fed, will Powell's tone be hawkish or dovish?
Buy a gold Rolex.
Gold Rolexes don't appreciate that much, to be honest. There's a couple of specific, like, obscure ones that do. Gold Rolexes are not worth more. Generally, the the non-gold Rolexes are the better ones, because typically, as you get to like the upper echelon of like consumers, they don't want a lot of gold. They think gold is like gaudy, and a lot of them don't feel like getting robbed. Yeah. And so,
well, I think there's something to understated kind of, I remember something that my dad always told me was
riches yell, wealth whispers.
Riches yell and wealth whispers.
I say that quote on stream because it's a good quote.
That's from my dad.
No, I know. I told him it was from my stepdad. My stepdad always says it. It's honestly absolutely true, though, right? Like, you see people. I always made a joke when I was growing up, and the joke was, if you see anybody with money on their shirt, like if you ever see pictures of dollar bills on somebody's shirt, like they're almost certainly not wealthy, because people that actually have money don't want to be targets. They don't want to be targets. Like, they don't want to be targeted,
Absolutely. And that makes, yeah.
Yeah, Quan, so you probably don't understand how it goes with Rolex, and they might do this intentionally, right? So again, will Powell's tone be hawkish or dovish after today's 25 basis point cut is what we're going to do as the poll. Vote of the poll. So yeah, so Quan, with Rolexes, you can't go to a Rolex store and buy one, brother. The reason, like, if you go to a Rolex store, they're gonna make you wait years to get it.
Well, that creates that kind of exclusivity.
Sure.
Kind of.
It's like Popeyes. The easiest way to put it is like Popeyes, right? If y'all remember years ago when the Popeyes chicken sandwich came out,
oh yeah,
Popeyes did a super smart marketing strategy, and it freaking worked.
People fighting in line and stuff.
Yeah, and then the Nintendo Switch did the same thing. When the original Nintendo Switch came out, you couldn't get them. They didn't produce enough to get them. They made them such a desired thing because there was artificial scarcity that prices skyrocketed. Popeyes chicken sandwich did the same thing. They debut this chicken sandwich, and they don't give enough to where everybody gets to get one. And so they had lines going out the door. Everybody wants these chicken sandwiches. If they hear a Popeye's got a chicken sandwich, they're running to it. Artificial scarcity is what a lot of businesses do. Yeah. And same thing Rolex does as well. Rolex will not sell you some of these watches.
Yeah, no, I remember that. That was crazy. I remember seeing some videos that just blew my mind.
Somebody says, explain to us what rate cuts means for the economy. So rate cuts is exactly as the name suggests. They're cutting rates. They're cutting interest rates. They're cutting interest rates to short-term. They're cutting short-term interest rates called the federal funds rate, which is the amount banks charge each other to hold money overnight. Eventually, it'll trickle into everything else, right? The longer-term mortgages and loans it is, the longer it'll take for it to trickle into it. It's more of an indirect effect there, but it'll directly influence like adjustable rate mortgages, because adjustable rate mortgages, adjustable rate loans are directly influenced by these rates, right? Because they're the rates that the rates adjust to. And so in the end, when rates are lower, and this is a small cut, a 25 basis point cut's only 0.25%. So this is a very small cut. It's not like a monstrous cut or anything like that. It's a very small cut. It's not a huge cut at all. But if we continue to cut rates for the next 4, 5, 6 meetings, by the time next summer rolls around, we might have a couple full percentage point drops in lending, right? And that is good. Typically, in that situation, people are going to have cheaper access to money. They're going to spend more, and it might stimulate the economy in a more profound way. And yeah, and other things like home equity lines of credit, they're directly influenced by these rates, by the federal funds rate. Again, long-term rates will be influenced by them as well, but it's a little bit more nuanced for that type of stuff. But in general, we're controlling rates, and there is a lag. So we cut rates today. In order for it to hit mortgages like long-term 30-year, 15-year fixed rate mortgages, it's going to take time, and it's more of an indirect effect, but it's still something where we cut rates to stimulate the economy. The other thing you want to pay attention to, the last meeting, I believe Powell and the Fed said that they were still doing quantitative tightening. So what tightening is reducing the Fed's balance sheet. It's taking liquidity away from markets. Quantitative easing is kind of the opposite of QT. It's called QE. What it is a form of money printing in which banks create online reserves, and then they use those online reserves to buy like bonds, injecting liquidity into these markets, stimulating the economy, allowing interest rates to go down. It's more of a desperate thing though. So they only do this in periods in which we have like potential disasters if we don't do anything. Like they did this in 2008 with 2008 mortgage disaster. We did this in 2020 to save us from the pandemic. They also did stimulus checks, but the consequence of QE is inflation. And so the Fed's actually doing the opposite of that, which is good. And I'm okay with the Fed doing QT and then simultaneously cutting rates as like a balanced effect on rates. I'm okay with that. I just don't want them to cut rates and do quantitative easing, because then that's where inflation starts to get worse fast. And when inflation starts to snowball, it can get worse really, really quickly, really, really fast. It's not what you want. Economy is doing just fine. Cutting rates makes no sense. I mean, in some areas it's okay, in some areas it's not. Like the payroll numbers were expected at 110, 120,000. They ended up showing 12,000 on Friday, which is 90% worse, roughly 90% worse than expected. Unemployment's at 4.1%, I think. So it's right around 4%, which isn't bad. GDP is at 2.8%, but it did drop a little bit. So it's not that, I don't think it's that we're cutting rates because the economy is weak. I think we're cutting rates because we've raised them so aggressively in like a 3-year period where it's probably time to start bringing them back down again, I guess, in the Fed's mind. I don't necessarily agree. I think I'm okay with them keeping interest rates high. And so if we look at like the Fed funds rate, I showed this graph earlier.
Yeah, right here.
No, that's CPI inflation.
Oh.
So I showed this graph earlier. We raised rates really aggressively, and we paused them there for a year straight. I'm okay with starting to lower rates. People are generally going to be happy when rates go down. Another thing is like people are going to be able to afford more homes. It's a nuanced thing, because as rates go down, rent typically is a little bit cheaper. Obviously, eventually, in theory, the big thing going on right now is that if people are skeptical regarding future economic outlook, regardless of whether we cut short-term rates, mortgages and stuff like that might still go up, right? So mortgages are going to be influenced by perception of the current economic state of the country. Now, maybe with the election, I think stocks and stuff like that, maybe people are more optimistic. I'm not sure. They also were fearing like tariffs, though, because one of the things the person that won said was that they're going to do tariffs. And if we do tariffs, that might negatively impact the economy. And I know a lot of people are saying that's why mortgages shot up short term.
But how much did the energy policies factor into that? The difference in his energy policies and overall inflation, because they're directly correlated.
You got to look at it like this. So you got to look at it like this. When the economy's thriving, it can be a good and bad thing, right? In theory, you always want a good economy, but the consequence of a thriving economy is inflation. So like if I'm running a business and my business is thriving, say I sell bubble gum for 25 cents a piece, and I put out 1,000 pieces of bubble gum every day, and at the end of the day, those 1,000 pieces are all bought up, right? What am I going to do? I'm going to bump prices up. I'm going to raise them to 40 cents a piece, because I can. And that is that's like the economy in a nutshell. When the economy's doing well, everybody loves it, but the problem is prices go up faster and faster and faster and faster. And I worry about inflation. Like, I don't want to see, $100,000 is great, but it's not what it was 5 years ago. And if we let that trend continue, it's going to get worse and worse and worse and worse. And so I'm more worried about inflation. But again, some of that is selfish, right? Like, I don't really need a loan right now, a mortgage. I'm not really getting lending right now. And so I'm okay with, making sure inflation is really under control.
I'd love for my grocery costs to go down.
Yeah, well, that's a little bit more nuanced. Grocery prices, a lot of the time, grocery prices are impacted by like supply chain, right? So the reason prices for groceries went up so much is because during the pandemic, the supply chain was so interrupted by everything going on, right? And
Yeah,
so,
I remember.
yeah, and so where we paid for that was prices in groceries. Like we had to pay more for groceries.
Yeah.
Let your wife talk a bit. I'm pretty sure if I didn't talk, she wouldn't talk either. You know.
I'm kind of new. I feel kind of awkward a little bit. Sorry.
Nick says Nick says I'm showing off in front of my woman. Honestly, I say the same thing every day. Carol's never here. I say the same thing every day. Really, I say all this stuff.
That's okay.
Yeah.
I love a little bit of show off, you know.
Yeah, I got to show off sometimes.
A little bit. Yeah.
No, she doesn't trade at all. Is it a bad idea to get a mortgage right now? I don't know if it's good or bad. If you talk to a lender, they're always going to act like it's the greatest time to get a mortgage. I don't know. I would just be careful. I think it's kind of up in the air. It really is. We got to see how everything looks next year. And so it's really up in the air. If the Federal Reserve aggressively cuts rates leading into next summer, you know, I wouldn't get a mortgage right now. Because then prices might go down and you're going to pay, you know, unless you got an adjustable rate, which can be good or bad. But
and I don't trade, but I'm in some like CDs, that type of stuff.
Yeah.
And my banker had told me that, you know, that they were anticipating that they were going to cut rates. So
yeah.
And I locked in a longer term just in case they do really start cutting them. So
yeah.
Anyways.
Yeah. So I see somebody saying, John, what's a realistic chance we get no rate cut? No cut, 1%, maybe less than that. I don't think it's very high at all, but I would say 1% or less is the chance that we get a no rate cut. It's almost certain we're going to do 25, right? Like, so I think the easiest way to put this is if we look at the FOMC Fed watch tool right now, it's pretty probable that we're going to cut rates. Like, look, so we can take a look at this here. It is less than 1% chance of anything but a 25 basis point cut. There's not even an option for, let me refresh this just to make sure. This thing changes so much. Yeah, so less than 1% chance. There's not even an option for a pause. This is a 50 basis point cut. So I would give it like 200 to 1 scenario that we pause today. But you never freaking know, man. And maybe the Federal Reserve is just going to shock people. I really don't know. I guess she's not subscribed. No, she probably is.
Yeah, every now and then when I'm running around, I'll check and log on and kind of look at his stream to see if he's still working, because I don't, believe it or not, I really don't want to call when he's working and when he's on stream. So I'll go check him on stream, and every now I'll kind of listen in. But yeah, so I am subscribed.
Kind of, you know. She watches me anyway. She hears all this stuff anyway.
Yeah.
What are the chances of a 50-point cut and 1% or less? We're about to hawk 2 on the NASDAQ. Well, the NASDAQ is just up big. Here's the NASDAQ right here.
I love how memes have come part of like the culture and like the vernacular.
Yeah, they're everywhere. Yeah. Hawk 2, honestly, she freaking got so famous from just like one little saying. Super famous, which is kind of crazy. But the question I have, the real worry I guess I have between all this is like, what does that mean for everybody else? Like, if people are getting that famous from saying the most dumb stuff, is that going to drive young people to just say riskier and dumber things? And I think it will, right?
Yeah,
that's the problem.
Well, when they see that, I mean, and it's very much kind of shock culture.
Right, it's shock culture, right? Yeah, I would just be careful, you know.
Yeah. Because the internet is forever. So whatever you say on the internet, even if you don't agree with what you said in 10 years, it's still going to be there.
Oh, it's there.
So your family, your employer, your kids, they'll find it, you know.
Yeah, for sure. Oh, they're going to be on there. All right, guys. SPY break it down. NASDAQ down. What do you guys think we're going to do? 25 basis points. Do you think Powell, let me know in chat right now, do you think Powell will be hawkish or dovish? Hawkish or dovish Powell, guys? I don't know. So 25 is pretty likely. So whenever we have these rate decisions, a 25 basis point cut is actually pretty likely. Outside of that, you have to look at what Powell says. So Powell's going to say basically, like, we'll read off what he says when it comes out, but Powell, we have to listen to what's called his tone. So we have to listen to whether he's hawkish, means he wants restrictive monetary policy and high interest rates, or whether he's what's called dovish, which is the opposite, less restrictive monetary policy. Less restrictive monetary policy, lower interest rates, all that stuff. Yeah, we're getting everything up there. Dovish. Let's see. Pause. Hawkish. I recognize Carol from that airline interview.
Oh yeah.
I've shown that airline interview on here before. Yeah. Usually it's when giving away the Scott story about how crazy stalker Scott.
That was scary though. That whole incident. And John was like nervous about flying. We were going to New Orleans for a wedding, and it was a good time.
I'm like, I don't want to fly. I don't want to fly. Carol's like, it's gonna be fine. Don't worry. Nothing's
like in the
gonna
back
happen.
Of the plane, and it's hot. The air is not really moving, and all of a sudden the mask come down. And John, I took a. Did you show him the picture?
I don't know if I showed him, but
okay. So I took this picture, and it was when I don't remember. I think we were wearing the airline mask, but you could just see like sheer terror in John's eyes, and like he was so upset with me for taking that picture.
Yeah.
Because I've flown enough, and I'm kind of like, well, we'll probably be all right. I guess. So we'll probably land at some point and get off the plane. But John's like looking at me like he was not happy to be there.
Yeah.
Let's see if I can find that picture.
Yeah, it's a good picture. It's a funny picture now looking at it in hindsight. So yeah, guys, so we got 11 minutes left, a little bit less than 11 minutes.
When was that? That was like 2019.
Yeah.
I'm gonna find the picture for y'all.
Yeah, it was. All right, so again, guys, FOMC releases their rate decision. It's almost certain to be 25 basis points at 2 p.m. Full conference with Powell will be streamed live here at 2:30. Subscribe, hit the notification bell. We appreciate it. Looking back up on the chat. This market is nuts. It's honestly crazy. Is a cut expected? Yeah, cut's super expected. Oh, no, I know. I'm not really worried. I'm usually fine when I fly. Like, I get nervous leading up to it more than I get nervous once we're on it.
Still looking for the picture, y'all.
Oh, yeah, she'll find it. Powell tried his best. So 2 p.m. is when the actual rate decision is announced. The actual press conference will be at 2:30. We'll stream all of it live like we always do. No, the cut was pretty priced in leading into it for the last month straight. Like for the last month straight, the overwhelming odds are that we're going to cut rates, not anything else.
It was later. It was like 2017, 2018.
Yeah. All right, chat. We got 10 minutes.
Okay, I found it.
Yeah, I don't know if you should buy or sell. 9 minutes left. Really got about 8 minutes left. We got about 2,000 people watching, a little bit less than that. VIX isn't worried about it. Where's the VIX at? VIX is at 15, so it's pretty low. Oh, Carol found the picture.
Yeah, I found the picture. All right, you ready?
Oh, great.
Okay. So here. Oh, wait, here. Okay, so here's the picture. Look at John.
I was not happy in that moment. I was not happy in that moment. Anyways, the SPY at almost 595s. Almost 595s. We'll see if it holds. Gold goes down. Let's look at gold. Here's the NASDAQ. There's the SPY. Yeah, I was definitely not happy.
It's the airplane mask.
Yeah. I'm from Louisiana, Baton Rouge, Louisiana. Market was booming during the summer on an FOMC day that it dumped after he made a bullish statement. Yeah, you got to be careful. That's why I like taking a big position now is risky ahead of the FOMC meeting. Like taking a big position now is risky. It's something that you just want to be really careful because nobody freaking knows what we're going to get. We're going to stream the full thing live, gamers. So you won't have to go anywhere. We'll stream the whole thing live. The rate cut's not, the actual rate decision comes out in 7 minutes, which is, again, it's going to be a 25 basis point cut. If we look at this, right? So this is where the actual thing shows up. You can kind of see all of this here. Here's the last one where we had the statement. The press conference is here, and then the minutes report will be coming out 3 weeks after this. So, yeah, trading FOMC always super risky. You just want to be careful. Yeah, no, I'm fine on planes. I don't ever freak out or anything.
Well, for the first period of our relationship, and
we didn't fly for
together,
like 10 years.
Yeah, because we had Maddie, and then we had Jack, and they were both really young, so we really didn't travel too much. But then once they started getting older, we started traveling more, and this was when we kind of first started leaving them. And like I had a cousin that got married or whatever, and yeah, so, and now we've flown plenty, but with just us and as a family. And so, yeah, but that was the one time that it was like when we first kind of started flying and traveling again. Sure. That, of course, that happens.
Yeah. So looking at the votes. So 40% are hawkish, 34% are dovish, 26% are neutral altogether, which is interesting. It really is a situation where, like, we'll have to wait and see what happens, but I wonder if the FOMC meeting is like, what's it going to do? We also have some earnings after the bell today, too. The FOMC meeting. So the rate decision is going to be right now in 5 minutes, chat. 5 minutes. So be careful. Hit the subscribe button. Hit the notification bell. Make sure they're not. Okay, yeah, they just got some weird thing up beforehand. Okay, so we're still waiting here. We're still waiting. All right, we got 1,800 people here. We got 4.5 minutes, about 5 minutes. No energy drinks for Carol. Neutral because there's literally no difference in the economy. What's your sentiment about the market, up or down? I have no idea what this is going to do to markets. Neutral here. Hey, what's up, Lafayette? They're cutting imaginary debt rates. Any idea about mortgage rates? Mortgage rates will take longer. So mortgage rates will take longer to be influenced by this, right? So like this is going to affect short-term rates the most, like adjustable rates, home equity lines of credit and stuff like that. Long-term rates are going to take longer to be influenced because they're longer term. And so they're a little bit more nuanced, but eventually it'll trickle into it, but it takes more time.
And yes, he is drinking out of a jam jar. We got rid of plastic.
I'm from the South, bro. I'm from the South. I drink out of jars. Okay?
Well, we got rid of all the plastic cups.
Yeah.
And so glass is the next best thing, I guess.
Yeah, Bitcoin has been flying up though, man. Bitcoin all the way up to 77,500, 77.1, 77.2. So Bitcoin just broke lifetime highs before this, which is kind of crazy. Again, we still have about 3 minutes, 3.5 minutes left, 4 minutes left. Yeah, I hate the small planes too, but don't see markets pulling back anytime soon with the VIX so low. Yeah, VIX is low. Again, let's get ready. SPY moving up. Lifetime highs on the SPY have to be pretty close to where we are now, aren't they? Where's the lifetime high on the SPY? Okay, I guess they're actually right here where we are now. Okay, so yeah, SPY broke lifetime highs again today. It's right around that too. This could boost it up more. I'm not sure. Part of me wants to be bullish just in terms of maybe it's confirmation bias. But part of me wants to be bullish through this meeting. The other part of me understands that like this might be risky. Just because we're up so much already. I'm going to put it in sub only mode as well. chat. So we're going to put it in sub only mode. So if you haven't already subscribed, we got about 2,000 people here. We still got a few minutes left until the report happens. What happens to gold if the Fed cuts rates? Anything that signals economic stability will make gold drop sometimes. But gold can also move a little bit more independently to all this stuff. Like gold can move with the market, which is what it's been doing. Gold recently broke all-time highs at 2,800 a couple weeks ago, but it's slower now. All right, guys, 2 minutes. 2 minutes. I was looking at Bitcoin futures, actually. Let me see. Here, I'll look at Bitcoin through this lens. Here's Bitstamps. Okay, Bitcoin at 76,000 all-time highs. Sorry. 76,500. Look at Bitcoin just shoot up right before this. We got about a minute and a half left, though. This big bubble stock market needs to crash. I am drinking tea. Vanilla tea. Are you not worried that everything is up a big bubble? I think it's possible, but I still think it's risky. We'll have to wait. Yeah, you can look at Bitcoin futures too. All right, guys, here we go. All right, so here's the SPY. We're going to keep the SPY up right here. We can put Bitcoin or gold up. I'll just put Bitcoin up. I want to see if it influences Bitcoin. We can put all three actually up here real quick. Bitcoin. Here's gold. All right, there's gold. Bitcoin. All right, here we go. 20 seconds, guys. 20 seconds. Here's Bitcoin. Here's the SPY right here. All right, here we go. Again, it's overwhelmingly probable that they're going to cut 25 basis points. The meeting will be the most important thing, and we're going to stream that live like we always do. And here's the decision right here. Market hasn't really moved much. They did a 25 basis point cut is what this is. 25 basis point cut. So yeah, 25 basis points, 4.5 to 4.75. So a 25 basis point cut. We'll put this up on screen. I told you guys this is what they were going to do. Not a shock. We'll go ahead and read the statement really quickly here, but it's a 25 basis point cut. Well, no, because the actual report doesn't happen, or the actual press conference doesn't happen. So again, it says recent indicators suggest that economic activity has continued to expand at a solid pace. Since earlier in the year, labor market conditions have generally eased and the unemployment rate has moved up but remains low. Inflation has made progress towards the committee's 2% objective but remains somewhat elevated. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the long run. Judging the risk to achieving its employment and inflation goals are roughly in balance. The economic outlook is uncertain, and the committee's attended to the risk to both sides of its dual mandate. In support of this, they decided to cut rates 25 basis points. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risk. They will continue reducing its holdings of Treasury securities. So they're going to continue to do QT here, is what this means. They're going to continue reducing their holdings of Treasury securities and agency debt and agency MBSs. They're strongly committed to supporting 2% inflation objectives and assessing the important stance of monetary policy. The committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of policy as appropriate if risks emerge that could impede the attainment of the committee's goals. They'll take into account a wide range of info, including readings on labor market conditions, inflation pressures, and inflation expectations, and financial and international developments. So yeah, they cut rates 25 basis points. Gold is going down, I guess, and more look at economic stability. Bitcoin has actually dropped from this as well. Look at gold fall on the right side here. So gold is going down. Look at gold fall. So gold's decreasing here. The SPY is pretty much flat. It's kind of starting to move up some. So the SPY is starting to bounce some here. Yeah, so again, 25 basis point rate cut. We're going to stream the full meeting like we always do. So stick around. Again, the Federal Reserve.
Gold's really going.
Yeah, gold's falling pretty quickly here. I am seeing noticeably less interest for this meeting. Noticeably less interest than normal for the Fed FOMC rate decision.
Maybe it's the overall with the election and everything. People want to see just how things kind of pan out over time here.
I think so. I think people are probably, I think what happened is that this is pretty overwhelmingly probable that we're going to cut rates 25 basis points. So I don't think it's like a shock that we're going to cut rates 25 basis points. I don't think that's a shock or anything like that. I think it's just pretty probable that we're going to cut rates 25 basis points. And so nobody's really super like shocked to see it, is what I think it is. Saturated. Yeah, I think so too. This is my wife, Carol.
Hello.
Are you taller than your wife or same height? All right, let's stand up.
No, it's the chair. I mean,
Hey, baby.
yeah,
How you doing?
yeah. No, it's just the chair. He's sitting on his.
I'm like a foot taller than Carol.
Yeah, I know.
Honestly, she makes me feel so tall. You know, I love you.
Yeah.
I'm sorry.
Pretty short. Yeah.
Yeah.
Hello. I know. I feel lucky. You know, we've been together for like a long time now, though. You know, it's
Yeah,
crazy.
like 14 years.
Yeah. I think I was 18 or I just turned 19 and he was
21.
Yeah.
Something, you know. I don't want to tell him how old I am though, so I have to like, you know.
Yeah.
She does make me feel taller for sure. Honestly, gold's dumping down here right now. Gold's at 26.97 right now, 26.97. So gold's falling here, chat. It's going down. All right, so we got the FOMC meeting live today. So again, we got the Fed meeting today. The Fed meeting's in about 25 minutes. I'll put a timer up. Full press conference live in about 19 and a half minutes. Oh, wait. No. This is off in about 24 and a half minutes. There we go. Gold's breaking down. SPY is almost completely flat, honestly, which is crazy because we haven't moved. Like, the SPY has been going up and markets haven't really moved a lot at all, which is interesting. I'm in my mid-30s. I'm not going to be too exact, but yeah.
But we have a high schooler and a middle schooler.
Yeah.
It's crazy.
You're lucky you have a wife that supports you doing this stuff. Not many wives do. I mean, I make enough money, so it's easy to support, to be honest.
Yeah, but I was supporting you even when you were just starting this out. And I mean, I've always known that John was intelligent. You know what I mean? Like, I knew that he would figure it out. And so.
Yeah. Yeah, do y'all want my social security number as well? Yeah, honestly, we haven't moved to move. Like, news hasn't really been impacting this. The Fed meetings haven't really been impacting this. Next week, we got the CPI report, which is interesting too. Last week, we had CPI and stuff like that, but it's just been slow. It's been boring.
Oh.
Huh?
Figure that out pretty quick.
I know, man. That's why I never tell them how old we are when we met each other. Yeah. You know.
Yeah, but got some quick people in the chat.
They know. It's the internet, man. They know. They're ready for it. They're ready for that. They're just sitting here. Did you honestly think you would get this big this fast? I don't know, bro. Half the people here are like, oh, 20, you only got 3,000 people here, bro. You're struggling, man. It's like, get out of here. Like, they're just mad, and that's okay. Be mad.
I mean, I've always had faith in you, and I know that this was kind of like a labor of love kind of thing. Like, you were into the stock market and, into this stuff. And I really appreciated, too, that he could be home, that he could work from home.
Somebody's asking me about crude oil. Crude oil's spiking up today, but it's still slightly red from this report. So crude is, look how flat the SPY is. Honestly, I'm shocked that this doesn't have a bigger reaction. Well, gold's coming back some, but it's still pretty freaking slow.
Yeah. I mean, I guess it's basically what people had expected, though.
Yeah, maybe. It's just so boring right now, man. There's nothing going on. Market barely reacts to it. Trash was yesterday.
And he forgot to put it out the night before. So I had to, as I'm pulling out to bring the kids, I'm like, hey, trash. And it comes early. The trucks come early. And so I'm like, hey, trash isn't out. And so, of course, he had to run out and do it real quick.
Yeah.
But thank you for reminding him.
Yeah, if you watch the stream, I had to run out and do it. SPY started to move back up, though. So here's the lifetime high on the SPY. Is right here at 595.60s. So the SPY is actually very close to the lifetime high. So here's the lifetime high right here. Bitcoin's lifetime high is right up there as well. Gold's all-time high is pretty far away. I know, I see it. I always get skeptical about shout-outs, though. Hey, Stephanie.
Hello.
Honestly, they'll try to trick me into saying the most vulgar things on the stream. And so I'm always skeptical. They'll be like, hey, why don't you say hey to blank, blank, blank? And if I do it, then I'm accidentally saying some terrible word and I don't want to say it.
Yeah, no, that's not the case.
Stephanie, this is the only reason his name's Stephanie.
Hey, Stephanie. Hope y'all are well.
Yeah, y'all hit the subscribe button. Help me hit help me hit 150,000. We're getting pretty close to it. We're at 149,000 right now. Help me hit 150. We're getting closer. We are in sub-only mode. Fed doing QE. No, so the Fed's still reducing their balance sheet. So one of the things that you see from this report is that this part right here means that they're still doing quantitative tightening. So they're still reducing their balance sheet. So look, the committee will continue reducing its holdings of Treasury security and agency debt and agency MBSs. They're strongly committed to supporting employment and returning inflation to 2% objective. So, yeah, they're still basically reducing their balance sheet, taking liquidity away from the bond market, and ultimately causing a more hawkish approach on everything, or continuing a more hawkish approach on everything. So again, you can see this in support of these goals. They decided to lower the target range of the federal funds 0.25% to 4.25%, 4 3/4, and 4.5%. In considering additional adjustments, the committee will carefully assess incoming data. They're going to continue doing quantitative tightening, is what it shows. It basically says indicators suggest economic activity has continued to expand at a solid pace. Since early in the year, labor market conditions have eased and the unemployment rate has moved up but remains low. Inflation made progress toward their 2% objective but remains elevated. They seek to achieve maximum employment and inflation at the rate of 2% over the long run. They judge that the risks to achieving employment and inflation are roughly in balance. Economic outlook is uncertain. Attentive to the risks is what they're saying. So, yeah, that's where we're at now. Yeah, we got 20 minutes until the actual accompanying press conference that we get for this. Yeah, Carol's great. I love her. She's good. She'll come on the stream and BS with me for a little while, which is nice.
Yeah, y'all are very sweet. Thank you, though. I appreciate it.
Yeah,
I was kind of nervous coming on the stream because it's been a while.
Yeah, no, most people are nice. I would say 95% of the people are nice, and then the 5% of people who are not nice are really just unhappy with their own lives, right? And you got to take that as a vote of confidence, because it usually means that something I'm doing is making them self-conscious, and so they just kind of lash out through the chat, and that's okay. They can let it out. I appreciate it.
Yeah.
SoundHound, yeah, doesn't SoundHound have earnings today? I was watching SoundHound for a while, but and it's up big today, but I'm still skeptical of it. It's got an okay chart. It's not terrible, but you also have to see stuff like Supermicro Semiconductors and be kind of skeptical about some of these more new AI stocks. About crude oil, I'm not much of a crude oil trader. Crude oil a lot of the time reacts with like geopolitical conflict news and stuff like that. So like conflict news overseas will cause, a lot of the stuff that goes on with like crude oil, where it's influenced a lot by crude. Like if tensions overseas are high, then crude oil will spike because supply and demand scarcity makes it more expensive, and vice versa. When stuff overseas calms, oil is less scarce, and so there's a greater supply of it, so the price of it goes down. Price per barrel goes down.
Yes, we're both from Louisiana.
Yeah.
Yeah, I don't know how that happens.
I've been running the stream for like 7 years
Trying
now.
to do like the Midwestern.
No, it's not Midwestern. If I've gained an accent, it might be like a New York accent.
How'd that happen?
I don't have a New York accent. Like I talk normally. This is how I normally talk.
Yeah.
But I think talking on stream has just made it go away. Yeah, if you want to check out Top Step is a partner of mine. They give you a demo, test your skill with it. If you pass the test, they fund you. If you fail, you only lose what you pay for it. In this case, it's $50. It's the single best way to test your skill in trading. They give you a demo, test your skill. If you lose, it's not the end of the world. If you pass it, they fund you. And most day traders lose. And so if you try to fund yourself $5,000 account, $10,000 account, you're probably going to lose. But what's great about Top Step is that they give you a demo. It comes with real-time data. If you pay for a demo with real-time data outside of it, it's going to cost about the same. If you pass it, they fund you. If you fail it, you only lose the monthly subscription. And so it's the best of both worlds. And they paid out over $100 million to their traders. In the futures market, that's probably where most day traders want to trade anyway, because there's no PDT rule. You can day trade the SPY, the Q price action, and the NASDAQ and the E-mini. You can day trade gold. You can day trade some currencies. And it's just very similar to blue chip stocks with less red tape. And if you fail, it's not the end of the world. If you pass it, you get a 90% split, which is similar to funding yourself. And so if you want to check it out, here's the link. It's an affiliate of mine. Remember, I am terrible and I have no idea what I'm talking about. Don't copy me. I do trade off stream. You're not going to see all my trades. They pay me money and I am biased because of it. Check them out if you want to check out the link in the description.
Your disclaimer.
It's the greatest disclaimer of all time, they say. It might be where you're from, Mr. G. You can't trade pairs, but you can trade some currencies. Like you can trade some currencies.
Is Lucid that EV company?
Yeah, it's like you've seen Lucids.
Yeah, no, I've seen Maroon.
No, I'm not streaming Lucid earnings. Lucid's just not big enough for me to stream.
Their cars are pretty. They're cool.
They're cool, but I don't think they have the customer base they need to succeed as an EV brand. I just don't. I don't think they have a big enough customer base. I'm going to try to use my new headphones today. The Fed meeting is in 14 minutes. I'm going to try to use my new headphones.
Did you want me to put this one on?
Yeah, you can. It's just music. I'll let you listen to the actual meeting on my phone, but... All right. I'm going to switch my headphones before I forget. There's Mitch.
Hey, Mitch.
Okay, good. There he goes. We're connected. I'm gonna end this. Let me know if y'all can hear the music when I end the stream. People getting mad at me for talking. It's like, look, Carol can talk if she wants to talk. She just doesn't understand markets very well. And so like
I'm still learning. I'm still very much learning. So
if she has a question, I'll answer it.
Yeah.
You know. But if she goes into a big rant about like airlines, you know, I might have to like shut it down and talk about finance stuff just because we got a couple thousand people here.
And I don't want to interrupt like what he normally has got going on. So.
Women's rights. Hey, what's up, Mitch? Hope you're doing good, brother. Hey, man. Dude, these new headphones are weird. They've got like the sound coming from all these different angles. Strange. All right, guys. But yeah, we got the FOMC meeting today. The FOMC meeting starts in just a couple minutes. Still waiting here. Again, Powell speaks at 2:30 Eastern Standard Time, 2:30. What else do we have going on? We got CPI inflation data coming out at 8:30 next week. I don't think we have anything tomorrow. All right. What's your bias for CPI tomorrow? We don't have CPI tomorrow. We have CPI next week. Do you make money from streaming or trading? I definitely make way, way, way more money streaming than I ever do trading, for sure. 100%. I make much more money marketing. But at the same time, I don't really claim to be a good trader. It's not like I cover economic stuff like this Fed meeting and like CPI inflation reports and jobless claims, unemployment filings, GDP data. So like really my channel is about economics. And so, I mean, we can criticize my trading if we want, but like that's not really the point of it. We got Michigan consumer confidence tomorrow. Yeah. So that's tomorrow at 10 a.m. Does that mean Carol is better? She probably is a better trader than me, really. You know.
I know that I was doing like the short, kind of quick trading for a while. I forgot what you called it. Swing trading.
You were swing trading? Swing trading is good. I like swing trading. Swing trading can be profitable. A GT 500? I'm trying to think of GT 500. A Shelby? GT 500? Nah, it's too old, to be honest. It's just too old. Do you own any cannabis stocks? No, I don't like any cannabis stocks. The risk in cannabis companies is that they're not actually going to legalize anytime soon. Every politician says they're going to do it, and then they never do, right? Like, you'll see a politician be like, yeah, if I got power, I would legalize cannabis. And then they get power, and it's just kind of crickets for 4 years. Nothing freaking happens. They don't actually do it. They just kind of sit around not doing anything. It's because they want to look progressive.
It's only during election season.
Right. They want to look progressive, but they're getting too much money from lobbyists, anti-cannabis lobbying groups to actually do it, right? Like, that's ultimately what ends up happening.
Unless they put it on the ballot propositions.
Yeah, well,
and give it to the people to vote on.
Well, Texas is good too, but Texas doesn't have ballot initiatives here, right? So Texas doesn't even have ballot initiatives. Texas is like freedom, yeah.
No, they have them sometimes.
No.
They'll have propositions that they put on the ballot, but they're usually local that have to do with, the school districts or whatever.
But I'm talking about statewide ballot initiatives. They don't have that here in Texas. No. You got a dinosaur system. You got to go to a politician, and he has to do what's right, even though he's getting all this money from all these other lobbyist groups that are actually against what the public wants. In the end, it's just I'm not investing in cannabis stocks because I'm skeptical on when we're actually ever going to get legalization. Did somebody say my name, Snoop Dogg? Cybertruck, your dream car? Nah, bro. If it was my dream car, I'd buy it. To be honest, Sonny, like I could buy a Cybertruck and probably find some justification to write it off right now. Because it weighs over 6,500 pounds. I could write it off in some way or another. The real issue is that I just can't, I could find a justification for it, but it's not worth it for me to go through all that trouble. Powell speaks in 8.5 minutes. There might be a timer right here, right there. There is a timer right there. No, honestly, swing trading is the easiest form of trading, in my opinion. Like, if you wait for a stock to have bad earnings, if you wait for a company to have good EPS, good revenue, good guidance that drops 10% on its earnings report, and you buy that dip and you wait for like a week or two, most of the time that company's coming back and you can make a bunch of money on it. I did that for a long time. It's very profitable. You got to make sure it's like a blue chip, healthy legacy company. It can't be like ABC penny stock that just started up last year. It has to be like a legacy. Like you'll see it a lot with like Target or like Apple or Amazon or Walmart or whatever. You wait for those. Some of those give some really good dip opportunities.
Yeah, and everything I learn that's trading related. I learned from John. So.
Yeah, is this a fake Alex Karp in the building? Let me see. Where'd he go? It's a fake Alex Carp. It used to be called Stephanie Likes Big Stocks. Now it's called something else. Bro, stop pretending to be somebody else, Alex Carp.
Hey, Stephanie.
Yeah, Stephanie showing up again. Look, stop scamming people, bro. Come on now. All right, guys, we got 7 minutes left. 7 minutes.
Oh yeah, the organic Fruity Pebbles. It's a real thing though. Cascadian Farms. They have some good cereals.
Yeah, organic Fruity Pebbles.
Mm-hmm.
I'm not lying. I'm not making stuff up. I do like organic Fruity Pebbles. Hey, if you're doing all the talking, what's the girl next to you doing?
I'm learning.
She's not about to go after you, brother. I'm sorry. You know.
Yeah, I'm just here to kind of learn and understand more.
Yeah.
So,
She's just listening to me talk.
top 3 talkers in the world.
Huh? Yeah, definitely top 3
talkers.
Fastest talkers ever. Which is better, trading futures or trading spot? Well, it depends on what you want to trade. If you want to trade individual stocks, you know, in that regard, maybe you can like trade spot. If you want to get less red tape, have more access to leverage, futures might be better. Less red tape, I would say.
No, I'm not single. I'm his wife.
Yeah. Yeah, I should have known bringing my wife on the stream. We're going to have a bunch of dudes that are just like, what's up? You know? That's all right. Definitely top 3. Top 3 of my favorite wives ever, for sure.
Yeah.
His brain is just faster. Look, I'm going to put that up. I love you. It's not, though. No, they're talking about mine. My brain is just faster than yours.
Oh.
It's an insult. I'm sorry.
I don't know what even we're talking about.
Yeah.
What are you talking about?
What? My brain is faster?
How did that get there? Where did that come from though? What
people are getting mad at me for talking too much.
Oh.
They ask, why am I talking so much?
Well, you do this every day. So I mean,
yeah, I'm gonna talk.
It's your thing.
Sure.
So yeah.
The squirrel brain.
Where it came from.
Yeah. I do have a squirrel brain.
Yeah. I would think I had a little more of a squirrel brain now. Are you talking about being able to think about like all your different tabs open?
Yes.
Because like mine is like, okay, I got to pick the kids up and then I got to make sure that they're fed. And then we got that stain on the side of the house. Is it coming from the AC? Do I need to call the AC guys out here?
Yeah.
You know?
Yeah. So we
like different kind of tabs maybe.
For sure. Yeah. Yeah. So listen, guys, we have 5 minutes. 5 minutes until Powell speaks. 5 minutes. Will Powell be hawkish or dovish? You know, I know we talk about this a lot. Will Powell be hawkish or dovish? I'm going to try to find the fastest stream we got here. So I'm going to do my best. Hold on, let me see. Press conference. Okay, there's September. All right. Okay, 9. Okay, what's today? Today is 7.
Yeah.
Or no, today is the 11th. And then 7. Oh, it didn't do it. Okay. Pretty sure I can find it just at the home page.
You sure it's not reverse how they do the 7th of November?
No, it's right here. I can find it. The actual. Here's the statement. Yeah. All right, guys, you ready?
Oh, yeah, look right here.
Yeah. You guys ready? Let me see if I can get this on. And there we go. All right, guys, we got 3.5 minutes. Why does it look like that? Okay, there we go. All right, cool. All right, I'm gonna make sure it's the fastest stream out here. At least the top 3.
It's never going away. Huh?
No, I'm gonna use that. I'm just gonna beat that horse until it's dead. All right, guys, 3.5 minutes. I could probably throw another little chart up here. Yeah, what color will Powell's tie be? Is definitely the big question of the day.
I feel like it's gonna be like a navy.
Do you think navy?
Yeah.
I think it's gonna be like purple.
He doesn't go kind of classic. He likes to be a little more flamboyant.
I'm gonna go with like purple, but it's not like a flamboyant purple. It's more of like a maroonish purple.
Like a burgundy kind of.
Yeah, it's either that or it's like the most neutral color ever, like a gray. It's either gonna be like gray or purple. Like a maroonish
So we
purple.
won't do like red or blue because is it signaling of a political affiliation or something if he wears like a
you got to understand. No. So it's not
or
political. Blue. Red means bearish. Green means bullish.
Oh,
Traders are degenerates. So like
they're gonna read into every single little detail. Huh?
Yeah. So what color his tie is, what do you guys think? Red. People saying red. Red, purple, red. Yeah. Lavender. I don't even know what color lavender is.
It's lavender.
Mauve.
Mauve is like a pinkish purple.
Yeah, it'll be like it might be like a maroon, I would say. No. It's gonna be like a mauve, actually. Yeah, you're right. It's gonna be like a purple. I'm just gonna call it purple.
Well, lavender is also kind of like a purple.
It isn't like a light purple though.
Yeah.
Yeah, it might be a lavenderish purple. All right, guys, we got a minute and a half. Just to clarify here, chat, you can hear my music, correct? Right now, you can hear my music. I just want to make sure. Yes, we can. Okay, good. This freaking guy. What a terrible picture. Look, he didn't even get a good one. All right. Yeah, it's low. I'm going to turn the music off. I just want to make sure you guys can hear it. All right, we got 40 seconds left.
No tie equals anarchy.
Huh?
Someone said no tie equals anarchy.
Oh, he would never do no tie?
I love that.
He's the Federal Reserve chairman.
Funny.
He's got to wear a tie. Listen, I'm a no tie kind of guy. So like I'd like to wear no tie, but he's Jerome Powell. He's got to wear a tie. A lot of people are going to say the new president is going to fire him, but that's not going to happen either. That's never happened ever in history. So like you might dislike Powell, but it's unlikely he gets fired. Let me get the music. Where's the music coming from? Oh, it's coming from this. All right, cool.
Comes out in a t-shirt and some flip-flops and cutoffs or something.
Maybe.
No.
All right, bullish or bearish, guys? Dovish or hawkish? All right, here we go.
I said navy, right?
What? All right, here we go. All right, where's Powell at? Let's see the tie. Oh, there it is. You're welcome.
Yeah, it's like a mix between a mauve and a lavender.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has eased substantially from a peak of 7% to 2.1% as of September. We are committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the FOMC decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by 0.25 percentage point. We continue to be confident that with an appropriate recalibration of our policy stance, strength in the economy and the labor market can be maintained, with inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 104,000 per month over the past 3 months. This figure would have been somewhat higher were it not for the effects of labor strikes and hurricanes on employment in October. Regarding the hurricanes, let me extend our sympathies to all the families, businesses, and communities who have been harmed by these devastating storms. The unemployment rate is notably higher than it was a year ago, but it has edged down over the past 3 months and remains low at 4.1% in October. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years. Total PCE prices rose 2.1% over the 12 months ending in September, excluding the volatile food and energy categories. Core PCE prices rose 2.7%. Overall, inflation has moved much closer to our 2% longer run goal, but core inflation remains somewhat elevated. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we're attentive to the risks to both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 4.5% to 4.75%. This further recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we move toward a more neutral stance over time. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing policy restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. We are not on any preset course. We will continue to make our decisions meeting by meeting. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation is not sustainably moving toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can move more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Thank you. Given the expectation that the election outcome will produce policies that would meaningfully impact the U.S. economy next year, how is the committee taking these proposals into account for upcoming decisions, including potentially the next one in December? And can you give us any more sense of how proactive or reactive the Fed is prepared to be to changes in economic policies with the next administration?
Sure. So let me say that in the near term, the election will have no effects on our policy decisions. As you know, many things affect the economy, and anyone who writes down forecasts in their job will tell you that the economy is quite difficult to forecast looking out past the very near term. Here, we don't know what the timing and substance of any policy changes will be. We therefore don't know what the effects on the economy would be, specifically whether and to what extent those policies would matter for the achievement of our goal variables, maximum employment and price stability. We don't guess, we don't speculate, and we don't assume. Now, just in principle, it's possible that any administration's policies or policies put in place by Congress could have economic effects that over time that would matter for our pursuit of our dual mandate goals. So we, along with countless other factors, forecasts of those economic effects would be included in our models of the economy and would be taken into account through that channel.
Nick.
Chair Powell, Nick Timrose from the Wall Street Journal. Roughly 1 year ago, when the 10-year Treasury was flirting with 5% and 30-year mortgage rates were near 8%, you noted how higher borrowing costs, if they were sustained, could weigh on economic activity. Given that you've said you believe policy is restrictive and the Fed is now dialing back that restriction, are the growth risks presented by higher U.S. Treasury yields today any different from those you identified 1 year ago when inflation was still meaningfully above your target?
So I would just say this: we've watched the run up in bond rates, and it's nowhere near where it was, of course, a year ago. I guess the long run rates are well below that level. So we're watching that. Things have been moving around, and we'll see where they settle. I think it's too early to really say where they settle. Ultimately, I'm sure we've all read these decompositions of what, and I certainly have, but it's not really our job to provide our specific decomposition. I will say, though, that it appears that the moves are not principally about higher inflation expectations. They're really about a sense of more likelihood of stronger growth and perhaps less in the way of downside risks. So that's what they're about. We do take financial conditions into account if they're persistent and if they're material. Then we'll certainly take them into account in our policy. But I would say we're not at that stage right now. It's just something that we're watching. And again, these things don't really have mainly to do with Fed policy, but to do with other factors in the economy.
If I could follow up, is the September SEP, are those rate projections still valid? Do they still seem relevant given where we are now? You get halfway through the cycle between the last set and the next set. I wouldn't want to comment one way or the other. Let's talk about the data we've gotten since the last meeting. So in the main, the economic activity data have been stronger than expected. The NIPA revision was stronger. Certainly the September employment report was stronger. The October report, not stronger. Retail sales stronger. So overall, though, I think you take away a sense of some of the downside risks to economic activity having been diminished with the NIPA revisions in particular. And so overall feeling good about economic activity. So I think we would factor that in. At the same time, we got one inflation report, which it wasn't terrible, but it was a little higher than expected. So I think really the question is December, and by December we'll have more data. I guess one more employment report, two more inflation reports, and lots of other data, and we'll make a decision as we get to December.
Gina Smilik from the New York Times. Thanks for taking our questions, Chair Powell. When it comes to December, what will you be looking at specifically as you try to make that decision? And then as of the Fed's economic projections in September, you had written down 4 quarter-point interest rate cuts in 2025. Do you still think that those are likely? Is that sort of the baseline outlook at this point, or has that shifted? And if it shifted at all, can you give a little bit of detail as to why?
We don't fill out an SEP, and I can't characterize one that wasn't filled out today. So I can't really speak for kind of exactly where the committee is. I will just say for December, we're going to be, again, at every meeting, we're going to be looking at the incoming data and how that affects the outlook. As you know, we're in the process of recalibrating from a fairly restrictive level at 5.33%. After today's move, we're down 75 basis points. And we're asking ourselves, is that where we need to be? You know that we're trying to steer between the risk of moving too quickly and perhaps undermining our progress on inflation, or moving too slowly and allowing the labor market to weaken too much. We're trying to be on a middle path where we can maintain the strength in the labor market while also enabling further progress on inflation. We think that's where we are, but that's the question we're going to be asking in September and in other meetings. And again, I can't really update you on the committee's thinking because we don't fill out an SEP at this meeting.
Yeah, totally appreciate that. I guess when it comes to your own thinking, do you think that a full percentage point of rate cuts in 2025 is a reasonable outlook?
Again, we're going to wait and see how things come in December. I mean, it's just, I would put it this way. We're on a path to a more neutral stance. And that's very much what we're on. That has not changed at all since September. We're just going to have to see where the data lead us. We have, a whole 6 weeks of data to look at to make that decision in December. Obviously, I'm not ruling it out or in, but I would say, I would say that, again, we didn't update the SEP, so I'm not going to characterize, where the committee would be.
Howard.
Thanks, Howard Schneider with Reuters. I wondered if you could please elaborate, explain a little bit the two changes in the language of the statement here. In the first paragraph, when you say inflation has made progress, dropping the word further progress. And in the second paragraph, dropping the sentence that the committee had gained greater confidence that inflation was progressing towards its 2% goal. Is there any policy substance behind either of those changes in language? Is it meant to open the door to a December pause? Is it meant to communicate anything about the stickiness of core inflation in the last 3 months?
Not really, no. So let me tell you what we were thinking. So the test of gaining further confidence was our test for the first rate cut, right? And so we met that test in September, and therefore we take that test out. If you leave it in, then it's new forward guidance. It's brand new forward guidance. What do you mean by it? Are you requiring yet further? We have to say yes or no at every meeting whether we've made further progress. The point is we have gained confidence that we're on a sustainable path down to 2%. So that I would tell you is what that's really all about. It's not meant to send a signal. Neither of those is meant to send a further signal. And saying further progress, it becomes a test. We don't want to be. We don't think it's a good time to be doing a lot of forward guidance. There's a fair amount of uncertainty in that. In what I've said, the path that we're on, we do know where the destination is, but we don't know the right pace, and we don't know exactly where the destination is. So the point is to find the right pace and the right destination as we go. And I think there's a fair amount of uncertainty about that. And you don't want to tie yourself up with guidance. You want to be able to make sensible decisions as you go.
Steve Leisman, CNBC. Mr. Chairman, you talked about higher rates, perhaps from an expectation of higher growth. You didn't talk about it in terms of expectations of higher deficits. Is that something you think might be behind the recent rise in interest rates? And are rising deficits a concern to you?
So we don't comment on fiscal policy. And again, I don't have a lot more to say on what's driving bond yields. In terms of policy changes, though, let me give you a sense of how this works in the ordinary case. Let's say Congress is considering a rewrite of the tax laws. Doesn't matter what's in the content. So we would follow that. At a certain point, we'd think we see the outline. So we'd start to model it. And then we'd wait. And then at a certain point, the staff would brief the Fomc and say, these are the likely effects. There's lots and lots of literature on the effects of tax policy changes
on various parts of the economy. So we try to get smart on that, and then the law actually passes, and you'd start to put it. You probably run an alternative simulation before that happens, just to keep people trying to understand it. Then when it actually passes, it goes into the model, along with a million other things. So we have a very large economy. Many things are affecting it at any given time. And, a law change of some kind would go in there, but it would, it's a process that takes some time. Clearly, the legislative process takes a lot of time. And of course, the real question is not the effect of that law. It's all of the policy changes that are happening. What's the net effect? And, the overall effect on the economy at any given time. So I think that's a process that takes a lot of time and that we go through all the time with every administration constantly. And this will be no different. But right now there's nothing to model right now. It's such an early stage. We don't know what the policies are, and once we know what they are, we won't have a sense of when they'll be implemented or all those sorts of things. So I think I would just say we're not doing that now, and all that will take time, and it will be very much regular order when we do that.
If I could just follow up on Nick's question, are the current rates something you feel like you need to lean against, in that they go against the direction of policy by adding restriction to the economy, or do you just take them as a given and perhaps a signal that you should do less?
I just think the first question is, how long will they be sustained? If you remember the 5% 10-year, people were drawing massively important conclusions, only to find, 3 weeks later, the 10-year was 50 basis points lower. So, it's material changes in financial conditions that last, that are persistent, that really matter. And we don't know that about these. What we've seen so far, we're watching it, we're reading, we're doing the decompositions and reading others, but right now it's not a major factor in how we're thinking about things.
Chris.
Thank you, Chris Rugaber at Associated Press. You mentioned the positive economic data that we've seen since the September meeting, including the revisions to things like savings, higher GDP growth. We saw stock market jump yesterday. That's renewed some of the questions about why do many cuts at all in this with this backdrop.
So you're right. As I mentioned, and as you mentioned, the latest economic data have been strong, and that's, of course, a great thing and highly welcome. But of course, our mandate is maximum employment and price stability. And we think that even with today's cut, policy is still restrictive. We understand it's not possible to say precisely how restrictive, but we feel that it is still restrictive. And if you look at our goal variables, the labor market has cooled a great deal from its overheated state of 2 years ago and is now essentially in balance. It is continuing to cool, albeit at a modest rate. And we don't need further cooling, we don't think, to achieve our inflation mandate. So that's the labor market. Inflation has moved down a great deal from its highs of 2 years ago. And we judged, as I mentioned, that it's on a sustainable path back to 2%. So the job's not done on inflation. But if you look at those two things, we judged in September that it was appropriate to begin to recalibrate our policy stance to reflect this progress. And today's decision is really another step in that process. Overall, as I mentioned, we believe that with an appropriate recalibration of our policy stance, we can maintain strength in the labor market, even as our policy stance enables further progress toward our inflation goal.
Great. And just to follow up, what might cause you to pause rate cuts in December? What kind of economic data would lead you to that path? Thank you.
So we haven't made any decision like that at all. But we're in the process, as I mentioned, of moving policy down, our stance down over time to more neutral level. And as a general matter, as we move ahead, we are prepared to adjust our assessments of the appropriate pace and destination as the outlook evolves. So, for example, if we were to see the labor market deteriorating, we'd be prepared to move more quickly. Alternatively, as we approach levels that are plausibly neutral, or close to neutral, it may turn out to be appropriate to slow the pace at which we're dialing back restriction. Again, haven't made any decisions about that, but that's certainly a possibility. If you can think of it as similar to what we do with asset purchase, with asset runoff, with QT. So we reach a point where we slow the pace, much like an airplane reaching the airport slows down, and so it we're thinking about it that way, but it's something that we're just beginning to think about.
Edward.
Thanks, Chair Powell. So with the noise in the jobs reports that we've seen, and you look at the Fed's favorite inflation, PCE inflation, overall it's 2.1%, very close to the Fed's target, but core inflation is 2.7%, and it's been that way since July. So why doesn't this data give fuel to a rate pause for this meeting?
Well, so I think if you look at the 3 and 6 month, you're quoting the 12-month. So we look at all of them, right? But if you look at 3 and 6 month core PCE, you'll see they're around 2.3%. So we look at all of them, and we look at 12 as well. But what it's telling us is that we really have made significant progress, and we expect there to be bumps. For example, the last 3 months of last year, the core PCE readings were very, very low, probably unsustainably low. So that's why forecasts generally see a couple of upticks toward the end of the year. On the other hand, the January reading certainly looks like an example of residual seasonality, so that we saw last year. So when that falls out of the 12-month calculation in February, we should see a thing down. So it'll literally be a bump up and then down. We understand that. Overall, you see the progress on inflation, and you also look at the economy and you say, what is the inflation story now? Where's it coming from? So I point to a couple of things. One is the non-housing services and goods, which together make up 80% of the core PCE index, are back to the levels they were at the last time we had sustained 2% inflation, which happens to be in the early 2000s for a period of 5, 6, 7 years. So they're back to that level. What's not is housing services. So let's talk about housing services. Housing services is higher. What's going on there is, market rents, newly signed leases are experiencing very low inflation. And what's happening is older, leases that are turning over are taking several years to catch up to where market leases are, market rent leases are. So that's just a catch-up problem. It's not really reflecting current inflationary pressures. It's reflecting past inflationary pressures. So that's one thing. The other thing is, I'd say look at the labor market, not a source of inflationary pressures. Where's it coming from? It's not a very tight economy. What is the story about inflation? You see that catch-up inflation also in insurance and several other areas. So you're seeing. We're not declaring victory, obviously, but we feel like the story is very consistent with inflation continuing to come down on a bumpy path over the next couple of years and settling around 2%. That story is intact, and it won't be 1 or 2 really good data months or bad data months aren't going to really change the pattern at this point now that we're this far into the process.
So you're quickly trying to get to that neutral rate that you see, or do you foresee that you have some time to get there?
Nothing in the economic data suggests that the committee has any need to be in a hurry to get there. We are seeing strong economic activity. We are seeing ongoing strength in the labor market. We're watching that carefully, but we do see maintaining strength there. And so we think that the right way to find neutral, if you will, is carefully, patiently. Again, that's not meant to have a specific meaning, other than to the extent the economy remains strong, we have the ability to take advantage of that as we try to navigate that middle path between the two risks.
Craig.
Hi, Chair Powell. Craig Torres from Bloomberg. 2 questions today. Did you learn anything about what Americans think about the economy from the election results? First question. Second question. I want to talk about some labor market indicators, and I do so with great respect for your attentiveness to the maximum employment side of the mandate, Chair Powell. So the unemployment rate has been at 4% or higher for 6 months. One of the broadest measures of unemployment is up about 0.5 point from a year ago. Compensation gains are sliding back. The quits rate, a signal of labor market dynamism, has been heading down to that bad neighborhood of the 20 teens. So you have put a marker at Jackson Hole saying any further cooling is unwelcome. It is cooling generally a little bit further. So at what point do we reach what you would describe as a shortfall from maximum employment? Thank you.
Sure. So on your first question, I'm not going to talk about anything that relates directly or indirectly to the election. On the second one, this is the great question, and it's the one we think about all the time. So I'll just say a couple things. There's nothing really surprising here. What we know is that the unemployment rate is low. We also know that it's moved up significantly from a year or so ago. So we've seen a big change upward in unemployment. Sometimes that has meant bad things. So far, it doesn't appear to be. It appears that I wouldn't say that the labor market has fully stabilized, because I do think it's continuing to very gradually cool, but it seems to be in a good place. And our policy, of course, is designed to keep it in that good place, to maintain the strength in the labor market while also enabling further progress on inflation. You mentioned a bunch of indicators, and you're right. The openings to unemployment rate is back to a normal level. I would characterize it more broadly as normalizing. You mentioned wages. Wages are still running just a bit above where they would need to be consistent with 2% inflation, unless productivity is going to remain at this high level. If we see productivity, more sustainably at these high levels, then that would sustain higher wage gains. So I would say, in fact, you can say it the other way, that wage increases are now consistent with 2% inflation given current productivity readings. But of course, the lore on productivity readings is whenever you see high readings, you should assume they're going to revert pretty quickly to the longer term trend. That has always been the case for 50 years. But it may be that we're now 5 years. If you look at the NIPA revisions that came out a month ago, we're 5 years into a nice set of productivity readings, which are sustained and very healthy. But overall, it's a good labor market. We could talk about 20 different data series. We'll be looking at all of them, of course. But we don't want the labor market to soften much from here. We don't think we need that to happen to get inflation back to 2%.
Victoria. Hi, Victoria Guido with Politico. Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
Mike?
Michael McKee from Bloomberg Radio and Television. You talk a lot about what the data are telling you and how you are dependent on the data. But in terms of forward-looking assessments of the economy, what are you hearing from CEOs or other officials around the country? What did you hear today from the regional bank presidents about what companies and consumers think about where the economy is going from here rather than looking backwards? And does that match up with what your forecasts have been and what you think the appropriate policy path should be?
So it's hard to characterize a really interesting set of discussions we had, and of course you'll see them in the minutes in 3 weeks. But I would say this: I think the comments from our Reserve Bank colleagues and from the CEOs that they talk to are pretty constructive on the economy right now. Pretty constructive, feeling that the labor market is back to normal, to the point where it's no longer that much of a discussion topic in their worlds, whereas 2 years ago it was all they were talking about. So they feel like the labor market's in balance. People feel good about where the economy is. Demand is obviously pretty strong, and you're seeing 2.8% growth in the third quarter estimated. Maybe the year's 2.5%. This is a strong economy. It's actually remarkable how well the U.S. economy has been performing with strong growth, a strong labor market, inflation coming down. We're really performing better than any of our global peers, and I think that is reflected in what you hear from what I hear people hear from CEOs. I don't get to talk to a lot of CEOs in my job, but I hear what others summarize from those. And of course, I hear the Reserve Bank presidents do a lot of that. And it's pretty constructive overall. Now, that's not to say there are areas of caution and and things like that. But ultimately, overall, pretty positive.
Well, to follow up the areas of caution, if there were black clouds on the horizon that you identified as something you're watching, what would they be?
I think it's things like clearly geopolitical risks around the world are elevated, and just as clearly they've had relatively little effect on the U.S. economy. Now, that can change through the price of oil or otherwise, but people talk about those as something that's on the horizon all the time. But ultimately, if you look at the U.S. economy, its performance has been very good, and that's what we hear from business people, and expectation that will continue. If anything, people feel next year. I've heard this from several people that next year could even be stronger than this year.
Andrew.
Hi, it's Andrew Ackerman with the Washington Post. I just wanted to follow up on the discussion earlier on fiscal policy. Your predecessors, Greenspan and Volcker, spoke up loudly when they thought large budget deficits endangered economic or financial stability. Will you do that too? And right now we're in a period of full employment. We have large budget deficits and debt at historic highs that are rising. Is that something you'd speak out against?
So, I have said many times, no more, no less than what the predecessors you mentioned have said. And what that is that the U.S. federal government's fiscal policy is on an unsustainable path. The level of our debt relative to the economy is not unsustainable. The path is unsustainable. And we see that in, you've got a very large deficit you're at full employment, and that's expected to continue. So it's important that we, that to be dealt with. It is ultimately a threat to the economy. Now, I can say that. I don't have oversight. We don't have oversight over fiscal policy. I've said it on many occasions, just said it again.
Okay, thank you. I guess the other question is to follow up on Victoria's question. Do you believe that the president has the power to fire or demote you, and has the Fed determined the legality of a president demoting at will any of the other governors with leadership positions?
Not permitted under the law.
Not what?
Not permitted under the law.
Thank you.
Courtney. Courtney Brown from Axios. In response to Howard's question, you said it wasn't an ideal time to give forward guidance because of the economic uncertainties. Can you lay out what some of those uncertainties are and whether or not it includes some of the proposals that the president-elect has put out on the campaign trail? Tariffs, for instance?
No, I was not referring to the new administration's policies at all, nor will I today. So what I'm just saying is, as we look ahead, we know, and I mentioned this in my statement, that the risks are two-sided. I guess I should start by saying that we think that the economy and we think our policy are both in a very good place, And but as you look forward, you say, what are the risks? And one risk is that we would move too quickly and find ourselves having moved too quickly, and inflation comes back, and we lost our chance to get inflation back to 2%. So we have to avoid that risk, and that to avoid that risk, that means you want to move carefully. The other risk is that we move too slowly, and that we allow the labor market to weaken too much and do unnecessary damage to the labor market and to people's working lives. That says don't get behind the curve. So these two things are the two risks that we have to manage. And so we're in the middle there. We try to be in the middle and deal with manage both of those. Again, the idea is to support the strength we have in the labor market and in the economy, but also with somewhat less restrictive, but still restrictive policy, enable further progress toward our 2% inflation goal. This is a thing we're meeting by meeting, we're going to be making our assessment of what the right path is. It's not as important. The precise timing of these things is not as important as the overall arc of them. And the arc of them is to move from where we are now to a sense of a more neutral policy. We don't know exactly where that is. We only know it by its works. We're pretty sure it's below where we are now. But as we move further, there will be more uncertainty about where that is. And we're going to move carefully as this goes on, so that we can increase the chances that we will get it right.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The Economist. I know you don't want to share your decomposition of bond yields, but if you look at the break-evens, it is clear that longer-term inflation expectations do seem to have risen up at about 2.5%, for example, on the 5-year. That's up half a point from when you cut in September. Do you have any concern at all that longer-term inflation expectations are de-anchoring, or put another way, are anchoring at a slightly higher level? Thanks.
So we would be concerned if we thought we saw longer-term inflation expectations anchoring at a higher level. That's not what we're seeing. We're still seeing, between surveys and market readings, broadly consistent with, I looked at the 5-year earlier today, and it's probably moved, but it's just not. It's kind of right where it's been, and also it's pretty close to consistent with 2% PCE inflation. So that's one that's been a traditional one that we look at a lot. But overall, expectations seem to be, and really have throughout this, in a place that's consistent with 2% inflation. But you're right to say we watch that very carefully, and we will not allow inflation expectations to drift upward. But that's really why we reacted so sharply back in 2022 was to avoid that.
Kelly.
Hi, Chair Powell. Kelly O'Grady, CBS News. We just talked about what you've heard from business leaders on the economy, but many average Americans are still not feeling the strength of the economy in their wallets. So what's your message to them on when they might expect relief?
So you're right that we say the economy is performing well, and it is, but we also know that people are still feeling the effects of high prices, for example. And the world went through a global inflation shock, and inflation went up everywhere, and it stays with you because the price level doesn't come back down. So what that takes is it takes some years of real wage gains for people to feel better. And that's what we're trying to create. And I think we're well on the road to creating that. Inflation has come way down. The economy is still strong here. Wages are moving up, but at a sustainable level. So it's just, I think what needs to happen is happening, and for the most part has happened. But it'll be some time before people, regain their confidence and feel that. And we don't tell people how to feel about the economy. We completely respect what they're feeling. Those feelings are true. They're accurate. We don't question them. We respect them.
And just a quick follow-up, President-elect Trump has been critical of your performance. Any concern about his influence on the Fed's independence?
I'm not going to get into any of the political things here today, but thank you.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. What is your plan if we start to see stagflation?
So that's the whole plan is not to have stagflation, so we don't have to deal with it. So that is actually our plan. It's of course a very difficult thing because anything you do with interest rates will hurt one side or the other, either the inflation mandate or the employment mandate. I would just say that we've been able to see inflation come down a whole lot, much closer to our goal, without the kind of sharp increase in unemployment that has often accompanied programs of disinflation. So, knock on wood, we've gotten this far without seeing a real weakening in the labor market, and we believe we can complete the inflation task while also keeping the labor market strong, and that, of course, is exactly what we're trying to do.
Can you rule out an interest rate hike next year?
No, I wouldn't rule anything out or in that far away, but that's certainly not our plan. I mean, our baseline expectation is that we'll continue to move gradually down towards neutral, that the economy will continue to grow at a healthy clip, and that the labor market will remain strong. If you look at that will not change from the September SEP. That is our baseline forecast, and short of some exogenous event, that will continue to be our forecast for the foreseeable future. So. But ultimately, we're not in a world where we can afford to rule things out a full year in advance. There's just too much uncertainty in what we do.
Student Jean for the last question.
Hi, Chair Powell. Jean Young with MNI Market News. I wanted to go back to a comment that you had made about Americans being quite unhappy about the cumulative price level rises over the past few years, even though now inflation is back on a path to 2%. Would it be appropriate for the Fed to undershoot for a while on its inflation goal under the average inflation targeting regime, so people have a chance to catch up?
No, that's not the way our framework works. We're aiming for inflation at 2%. We did not think it would be appropriate to deliberately undershoot. And part of the problem there is that low inflation can be a problem too, in a way. But that's not part of our framework, and it's not something we're going to be looking at in our framework review. Thank you very much.
Okay, guys, so that is the end of Powell speaking here. I'm just gonna say we did get the purple tie absolutely right, so I'm gonna take credit for that.
I think it was a lavender.
Was it
lavender cup? Yeah,
it was a lavender tie, you said?
Yeah.
I think whoever said mauve. Wait.
I felt like it was a mix between mauve and lavender.
I think it was a mauve-ish tie, right? And again, just to clarify, prior to them saying what mauve is and me Googling it, I didn't know what color mauve was.
See, but there's so many different kinds of mauve, and to me, that looks more like lavender.
All right, I'll give him all right. He had a lavender tie, but again, here's the problem. If you're wondering, like, man, how did John predict purple? He wears a purple tie. He either wears a purple tie. I would say 80% of the time his tie is purple, and I think he's doing that. I'm not sure why. Maybe he knows, but 20% of the time he wears a gray tie. It's never anything outside of purple and gray. And so the reason I'm like, hey, let's guess the tie, and I'm always guessing purple, is because it's almost always purple. Mauvinder, hey.
Lavender.
So again, Powell, let me know again, here's the problem. Like, we got to say a lot of questions. Some people are like, hey, the current administration's going to fire Powell. Bro, the government and the Federal Reserve are two completely different things. They're different entities. Like, the government can't fire Powell, and if you look back at history, there's never been a time in which the Federal Reserve has been fired prior to their term ending. Basically, Powell's going to be here for the next 2 years and until 2026. There's not much we can do for it. I don't dislike Powell, but like, if you dislike him, you're SOL. He's gonna be here until 2026, right? They can't fire him if he wants to. Also, SPY is just now breaking lifetime highs here. So the SPY is up to lifetime highs. We're at 596.30s. This is the lifetime high of the SPY right now. Dude, the Fed is the government. It's technically not, though, brother.
Yeah,
Look here. Let's ask AI. Is the Fed the government?
It's a private organization.
It really is. No, the Federal Reserve, often called the Fed, is not part of the federal government in the same way other government agencies are. It's an independent central bank created by Congress. Again, it's not the government. They can't fire him if they want to, right? And that's what you gotta understand. The Fed, people hear Fed and they think government. Not the same thing. Fed just means the federal bank that the government uses, but it's not the same thing. It's an independent agency. They can't fire them. So. Yeah, they might pull the strings, but it doesn't mean they're the same thing.
But the name is sneaky. Makes you think it is,
John's colorblind? Am I really? Look, this is why I type in mauve right here. Look at all these colors that pop up, bro. I don't even look at this. I don't know which one it is. Don't get mad at me. I didn't know what mauve was.
I think it's different shades of mauve.
Mauve? I don't know, man. I don't know. I'm seeing this. The Fed meeting this year had much less interest, this 6-week period, much less interest. It wasn't just me, it's everybody that was covering this thing. It had much less interest. I don't know why. It's strange. Honestly, next week we got CPI inflation. We'll see what that looks like. Silver? You think you should buy silver? He didn't say anything. Yeah, it was pretty flat, pretty boring. Not a lot going on. Honestly, outside the market originally didn't react much to it. During his speech, the SPY broke lifetime highs and we're up to 596.50s. So like, we started to run pretty big amount here, but yeah. Can I respectfully buy your wife for $1 million?
No.
No.
You better say no.
Dude, no, I would never.
Yeah,
Listen,
right.
I've seen the movie what is it? Indecent Proposal or something like that. That's a heartbreaking movie. I can never,
I don't know what talking about.
And honestly, $1 million, while it would certainly make me happy, it's not going to cause any like deep life-changing amount of money for me. I'm not even trying to brag. I'm just saying it's not like, you know, yeah. I wouldn't trade her for $1 billion though. So.
Yeah, you paused though.
No, that was a trollish pause. I'm just messing with the stream. You're one of my top 3 wives I've ever had, you know, and so no. No, it's all right. Hey, listen, guys, if you haven't already, I appreciate the love. Thanks so much. Hit the subscribe button. Help me hit. We're getting very, very close to 150K. The problem is that everybody that watches these things are already subscribed, and so I appreciate the love. Thanks so much, guys. Have a good one. Yeah, hey, you guys as well. Hey, listen, we're going to be debuting a video. So the other day, we took 3 challenge accounts, and we tried to pass 3 different challenge accounts. Like you can only, on Top Step funded account program, they give you a demo. They test your skill with the demo. If you pass the test with the demo, they fund you between 50K to 150K. Your goal is to make $3,000 in profit on these demo accounts. You can only make $1,500 a day, and you got to make exactly $1,500 one day and then $1,500 the next. A few days, like a week ago, we took 3 of these accounts, brought them each up to $1,500 one day, and then tried to get funded the second day. And so we got a video debuting after this, a full walkthrough of that process, whether we got funded on all 3 of the accounts, none of the accounts, whether we were able to actually do it. That video is dropping full. It's a full walkthrough of Top Step. If you want to check out Top Step before you watch the video, here's the link. Great way to help support the channel. Yeah, no, I'm just joking. But again, I appreciate the love. Thanks so much, guys. I just subscribed. I appreciate you coming up for Fomc. Hey, thanks so much. I paused. Yeah, that's a troll pause. A lot of good information on the stream. We try over here. We try. Did he sound hawkish or dovish to you? I think he was pretty neutral, to be honest. I think he feel like he didn't want to give out any information. I think that he seemed a little snappy, a little snappy, you know, a little snappy when he got asked about the resignation question. So I thought it was interesting, guys. How much for the dog? Which dog? You know, Rosie, I would never trade for $1 million. Bruce, you know,
no, I love Bruce. He's stinky.
He stinks
flaky.
though, bro. Bruce stinks.
He's got some.
I love him. I would never get rid of him either. But
members, they become part of your family.
Yeah,
you know?
Yeah, I would never. But anyways, guys, we're gonna end the stream, and we're immediately gonna go to our debut of Top Step. So if you haven't already, again, hit the subscribe button, hit the notification bell. We're gonna end the stream. We're immediately gonna go there. I love you all. You'll have a great day.
Bye, guys.
Let me make sure this is set up. I'm pretty sure it is. Redirect.
All right, well, your chicken pot pie's ready.
Okay, my chicken pot pie.
Mm-hmm.
Okay, good. All right, guys, we're ending the stream. It's gonna bring you to the other stream. I love you all. You have